Hello, everyone. This is chapter 3, first part. Chapter 3 is working with financial statements, mainly about the ratio analysis. So what is the ratio? Ratio is the standardized measure when we compare the financial statements. One of the biggest problem we may face is the number is not standardized. It's raw number. So we cannot compare through time or between companies. So to get a ratio, we can compare better through time or between companies. We can use it internally and externally both. And for each ratio, we ask these two questions. What is the ratio trying to measure? And why is that information important? There are a number of ways to calculate these ratios. For this textbook, they use 5 categories. It's not decisive, but it's a good way to categorize the ratios. First one, liquidity. Second one is the financial leverage. Third one is asset management. Fourth one is the profitability, and the fifth one is market value. So, and this is the table to show the ratios, the all formulas, and we'll see one by one. The first one is the liquidity ratio. And first of all, we should know what liquidity is. So liquidity is the degree of ability to cover the short-term liability. Short-term liability include the account payable, note payable, wage payable, tax payable. This is kind of daily cash flow that you need to pay. We need to cover it. To pay it, we need to have cash. Because we cannot prefer all the liability as a cash form, we prefer for it as a form of assets, so-called current asset. Current asset is the one that you can use within a year. Usually we call this is liquid asset. We can convert these assets into cash easily without losing substantial values. So called the liquidity. So the liquidity ratio measures how liquid the firm is. If the firm is not liquid enough, then firm face the liquidity problem. The first one is the current ratio. Current ratio simply compare the current asset with current liability. We want to this current ratio above 1 because we want to have enough current asset to cover current liability. This company, Fruit Frog, our example, current asset is 708, current liability 548 is 1.29 times. It's above 1, so it means that it may be fine. It's not absolute bad, but we cannot say it's just fine because we don't know if this level is high enough. We'll talk about it later, how to compare. The next one is called the quick ratio. Some people argue that inventory is not liquid, so we have to exclude this inventory. Numerator, current asset minus inventory. So all current assets except inventory divided by current liability. We compare these two numbers. For Proof Rock, 708 current asset and inventory, so 422 divided by 548. 0.52 times. The third one is cash ratio. Now let's measure the amount of cash, because cash is the most reliable, most liquid. For this company, cash is 98 divided by 548 current liability, so 0.18 times. But these are three typical liquidity ratio we can get. First part quiz: calculate current ratio, calculate quick ratio, calculate cash ratio. Do it. The current ratio is current asset divided by current liability. Current asset is 36,260 divided by current liability 7,483. Current ratio is 4.85 times. Quick ratio: current asset minus inventory divided by current liability. So current asset 36,260 minus inventory 21,956 divided by 7,486, 1.91 times. Cash ratio: cash divided by current liability 5,827 divided by current liability 7,483. It's going to be 0.78%. Oh no, 0.78 times. The current ratio 4.85, quick ratio 1.91, and cash ratio 0.78. Next one, financial leverage ratio. So leverage is the amount of debt relative to the asset. If the leverage is too high, then your interest expense is too high. And if you don't pay back the amount of interest, then you are broke, right? So the amount of interest is related to the possibility to be bankrupt. We don't want to control the level of the leverage. The first three ratio is simply the measure of the amount of debt relative to the asset. First one is the most direct. Total debt ratio is the total debt divided by total asset. And we know that from accounting identity rule, total asset equals to total debt plus total equity. So from this financial statement, balance sheet, we have the debt amount is a short-term debt plus the long-term debt, but we can also get the debt amount, total asset minus total this total equity. So total asset minus total equity is the same as total debt divided by total asset. So 3,630 total asset minus 2,625 total equity, which is total debt, the amount of debt divided by total asset, 0.28 times total debt ratio. You can also compare debt to equity directly. The total debt is 0.28% times of asset, right? Which means that total equity should be 1 minus 0.28 times of total asset, 0.72 times. You can calculate that to equity ratio, 0.28 divided by 0.72 from total debt ratio calculation. It's going to be 0.38 times. The final one is the equity multiplier, total asset divided by total equity. You can rewrite this total equity plus total debt, which is total asset divided by total equity. The first part is 1. Second part is total debt divided by total equity, debt to equity ratio. That's why equity multiplier is simply 1 plus debt to equity ratio. For this case, 1 plus 0.38, 1.38. Again, these three measures, meaning it's the same, the direction is the same. If these are higher, then you have higher debt. Next to is a little different measure of the leverage. Now, again, because leverage measures the amount of debt is related to the amount of debt. If the amount of debt is high, then interest expense is higher. But even though your interest expense is higher, if you don't make enough money to cover this interest, you may be fine. So we want to know whether the company makes enough money to cover interest. The first one is the times interest earned, EBIT divided by interest. It measures whether this company make enough operating income to cover, to pay interest. Obviously, we want to have this is greater than 1. If not, then you are losing money. So these two measures is also called the long-term solvency measure. Long-term solvency measure. Times interest earned again, EBIT divided by interest. So proof rock, EBIT is 741, interest 141, times interest earned, 5.26 times. Some people may argue because EBIT is not cash measure. When you calculate the EBIT, we subtract the depreciation, which is non-cash item. So in fact, we need to make enough cash flow, operating cash flow, to cover interest. So let's add back depreciation. So EBIT plus depreciation divided by interest is cash coverage ratio, whether the company makes enough cash to cover interest. Proof rock, this company, 741 EBIT plus depreciation, 276 divided by interest expense 141, 7.21 times. Next pop quiz, calculate the total debt ratio, equity multiplier times interest earned. Solve it. So from this financial statement, the total debt ratio equals to, again, total debt divided by total equity. We can calculate total debt equals also total asset minus total equity divided by total equity. And total asset is actually 115,672. And total equity is 92,189. So 115,672 minus 92,189, that's the total debt, and divided by 115,672 equals to 0.2. That's total debt ratio. Equity multiplier, just total asset divided by total equity. And total asset, 115,672. And total equity, 92,189 equals to 1.25. Times interest earned, EBIT divided by interest. And EBIT is 36,807, and interest is 1,811 equals to 20.32 times. That's times to interest earned. So that's the end of the first part of the ratio analysis. We will look at the other ratio in the next part.